You'd think the food business would be a slam dunk, right? I mean, everybody's got to eat, but it's not that simple. Today, we're going to peel back the wrapper on that idea and get into the much more complex reality, the razor-thin margins that define this entire industry.
This quote just nails it, doesn't it? It's the ultimate expectation versus reality. You walk into a grocery store, you see all those products, or you see a packed restaurant, and you just assume they're rolling in it. But what you don't see is the constant behind-the-scenes battle against rising costs.
And that right there is probably the biggest myth in the food business. Our source material points out the #1 mistake people make. They think, hey, food always sells, so profits are going to be easy. But look, making a sale, it's just the first step. Actually keeping a decent chunk of that money as profit, that's a whole different ballgame. So, to really get a handle on this challenge, we have to talk about something called margin pressure. You've probably heard that term thrown around, especially in business news. And honestly, it's the single biggest reason the food industry can be so tough. So let's break it down.
Okay, so before we get into the textbook definition, let's talk about where you see this in the wild. Ever hear the term earnings guidance on the news? It's basically when a big company tells Wall Street, here's how much money we think we're going to make. So when a huge food company suddenly lowers that number, that's a massive red flag. It's their way of saying, uh-oh, our profits are getting squeezed.
And the reason they're doing that, it all comes back to margin pressure. Let me put it this way. Imagine you're selling a jar of pasta sauce for $5. It costs you $3 to make everything. The sauce, the jar, the label, shipping. You make $2 profit. Simple. But then, bam, the price of tomatoes, glass, and fuel all shoot up. Now it costs you $4 to make that same jar. If you can't raise your price to the customer, your profit just got sliced in half. That is margin pressure in a nutshell, and it is hitting the entire food industry.
So what's behind this massive squeeze? Well, our source breaks it down into 5 big factors. First, you've got raw materials. The price of stuff like wheat and sugar is all over the place. Then, you've got rising labor and transportation costs. On top of that, the big grocery store chains are powerful, and they demand lower prices from you. And to top it all off, we, the customers, are super sensitive to price hikes. It's like a perfect storm coming at these companies from every single direction.
Okay, so that's the why. Now let's talk about the how much. Because when you see the actual numbers, that's when the reality of this really hits home.
And yeah, this is a serious reality check. Just look at these typical net profit margins. A restaurant? They might only be keeping 3 to 10 cents on the dollar. The big food manufacturers? Maybe 5 to 15%. Even a cool small brand is often just in that 10 to 20% range. We are not talking about tech company money here, not by a long shot.
So here's the key takeaway from our source. For a food business to be considered truly healthy, it needs to be aiming for a net profit margin of at least 15%. And you might be wondering, why that specific number? Well, because anything less than that is just too risky. Think about it. One bad harvest, one spike in fuel prices, and your entire profit for the year could just vanish. That 15% isn't just profit, it's a survival buffer.
And this is where you really see the difference. Compare a food business with its sub 20% margin to a software company that can hit 50% or even more. It's like they're playing 2 completely different sports, right? With software, selling one more copy costs practically nothing. But in the food world, every single jar of sauce you sell needs more tomatoes, more glass, more shipping. It's not that food is a bad business, not at all. It just means you have to go in with your eyes wide open and a totally different set of expectations.
Okay, I know this sounds a bit doom and gloom, but it's not. We've laid out the challenges, but it absolutely does not mean profits are impossible. So if the averages are so tight, it begs the question, where are the smart folks finding the real money? Where are those hidden pockets of opportunity?
Well, it turns out not all food is created equal when it comes to profit. There are specific categories that just offer way better returns. The trick is knowing what they are.
And here we go. According to our source, these are the sweet spots. We're talking specialty snacks, think organic, high-protein stuff, health supplements, premium coffee and tea, fancy sauces and condiments. Oh, and spices and seasoning mixes, a huge one. These are all products where the brand and what people think it's worth allows for a much, much higher price tag.
So, what's the secret sauce here? Why are these so much more profitable? It really boils down to 3 things. First, the cost of the actual ingredients is often tiny compared to what you pay in the store. Second, branding is huge. A great brand makes you feel like it's worth paying more. And third, a really important one, they have a long shelf life. That means way less risk of product going bad and having to be thrown out, which just kills your bottom line.
All right, so now we know where the opportunities are. But what's the actual playbook? Let's get into some real, actionable strategies for both the people starting these businesses and for those of us looking to invest in them.
If you're a small business, your number one job is to protect that margin. The source suggests 3 really smart moves. First, sell direct. Build your own website so you're not giving a giant slice of your profit to a retailer. Second, be obsessive about your packaging costs. And third, find a niche and own it. We're talking gluten-free, keto, organic, places where your dedicated customers are willing to pay a premium and aren't just shopping on price.
And what if you're an investor? There's a totally different checklist. You've got to watch those margin trends like a hawk. Are they going up or down? Does the company have a smart plan for when ingredient costs go crazy? And maybe the most important question of all, do they have pricing power? That's the magic ability to raise prices without everyone running for the hills. If they have that, you know you're looking at a really strong brand. These are the vital signs you just can't ignore.
You know, this final thought from our source just sums it all up perfectly. It's so easy to get wowed by huge sales numbers, but real, lasting wealth, that's built in the margins. At the end of the day, it's not about how much you sell. It's about how much you keep.
And that really leaves us with one last question to chew on. And this goes for any business idea, not just food. Ask yourself, is your idea built for sales or is it built for wealth? Are you focused on just moving product, or are you engineering a business that's designed from the ground up to be truly profitable? Because that answer, that's everything.